What's up, my ninjas? Hope you all are enjoying the thug life. Today, we're going to talk about iron condors and the very basics. All you need to know beforehand is the basic definition of the Greeks of option pricing, such as theta, delta, vega, and gamma. You can disregard rho because that won't be that important for this video. Hopefully, in the future, I'll be getting more in depth into the advanced nuances of iron condors and non directional trading. So stop sucking that popsicle and pay attention. Or if you don't want to pay attention, you can pay me instead. I'll leave a link in the description for my Venmo. So, in simplest terms, an iron condor is a market neutral approach that can generate profits regardless of market direction. Unlike traditional stock trading, which often relies on predicting company performance, options trading focuses on probabilistic outcomes, which means there are ways to make money through options without solely relying on direction. With stocks, the only way you can make money is if the stock goes up or down, unless, of course, it's a dividend paying stock. Options trading is more akin to strategic gameplay, like chess, and stocks are like betting on a horse race. With stocks, you are either right or wrong, but with options, specifically option selling, and even more specifically with option spreads, you can be wrong and still make money. You can be the biggest dumbass in the world and still make money, which is why I trade option spreads because I am a dumbass. Even when I am day trading, I will trade 2 to 5 day DTE credit spreads because I always want theta decay on my side. And the reason I don't just flat out sell naked options is because it requires a lot more capital and it's just not capital efficient, especially on stocks. With futures, it's a little bit different, but we'll save that for another video. So the iron condor involves selling both a call credit spread and a put credit spread, creating a profit zone within a specific price range. Ooh. This trade structure can yield profits without needing to predict market direction accurately. A credit spread is when you are selling a strike that is usually out the money and you are buying another strike that is further out the money for protection. The reason we buy another option is to protect ourselves from extreme loss and it creates a defined risk trade. Very important there. If we were to just sell a naked option, then our risk would essentially be infinity. The iron condor strategy thrives in stable market conditions, where prices fluctuate within a defined range. Success hinges on theta decay or time decay and volatility, making it essential to monitor market conditions carefully. Every day that passes, you are making more and more through theta decay, which expands your window of profitability. Now, some people might ask, why not just hold the spread until expiration? And the reason for that is with options, there's always a trade off with the Greeks. The more theta decay we get means the more directional risk we have. With any trading strategy, including iron condors, understanding and managing risk is essential. You can experience significant losses if trades aren't monitored or adjusted properly. I'll make another video in the future getting more in depth on how to manage iron condors, but for starters, a safe way to start is to have a profit target of 10% of credit and to have a manual stop of 15%. The reason why we don't use an automatic stop of 15% is because of volatility. And certain times of the day, volatility will have extreme fluctuations and hit your stop loss order. Volatility is a key factor in options pricing. Knowing the difference between implied and historical volatility will help you make informed trading decisions. Generally speaking, you want implied volatility to be higher than historical volatility because it will help you get a better credit for your iron condor. The best time frame to sell iron condors is different for everyone depending on their risk appetite and whether or not they have some other form of edge in the markets besides just trading the math. Iron condors are generally systematic trades, but they can also be discretionary trades. For people just starting with iron condors that have zero eds and just want to trade the math, typically want to go out 6 to 8 weeks before expiration. This window allows traders to benefit from time decay, which is a key factor in the profitability of the condor strategy, and it also keeps directional risk low, so you won't get blown out from sharp intraday movements. A lot of people on YouTube tell people to sell iron condors 30 days out till expiration, but this is actually a very bad idea for beginners. Although theta decay speeds up when it's 30 days out, the problem is your directional risk will start overtaking your theta decay benefit the closer you get to expiration. So wouldn't recommend it for beginners. And on top of delta risk, when you get really close to expiration, you now have mega gamma risk, which is great for option buyers, but is the ultimate death for option sellers. For beginners, I would recommend closing out the position 1 month before expiration to minimize risk of market volatility while still capturing a decent profit. Now, I wouldn't recommend trading iron condos further than 70 days out in expiration because this exposes you to significant Vega risk. Vega measures how much the price of an option is expected to change with a 1% change in implied volatility. Longer dated options tend to be more sensitive to changes in volatility, which can lead to larger losses if market conditions fluctuate. Iron condors profit when Vega drops, so if price is moving against you and Vega is also rising, which can happen in a falling market, then you can end up with a big loss. Also, when your expiration is more than 70 days out, theta decay is very low, so you don't have a full advantage of profiting from the passage of time. Last thing I wanted to discuss is the topic of selling iron condors on different products. A lot of people would recommend selling iron condors on indexes and ETFs, and the reason for that is because the price of those products are not heavily affected by news like stocks are. Remember, this is a strategy that benefits from price staying in a specific range, and stocks can move dramatically from news and events like earnings. Although I think this is a good place to start for beginners, I think it's better to move to individual stocks or futures once you get more experience. The problem I have when trading indexes like the SPX is that options are usually priced to the T. They are perfectly priced. One of my main edges is to find mispriced options, and all that really entails is selling spreads where the short strike has high IV and the long strike has low IV. This will give me a much bigger credit while still keeping my max loss low. What that does is give me a higher percentage of success and profitability. As discussed earlier, IV is one of the main factors that controls the price of options, and it's the only variable that isn't actually known. Every other Greek is set in stone. There are no maybes with it. But with volatility, we can't know the exact input until after expiration. So a lot of times IV will be overshot because people think a stock will move a lot more than it actually will. With indexes and ETFs like SPX, if you want a high probability trade, then you are going to have to trade off a good credit and your max loss will be a lot higher. Also, many people advise people to not trade iron condors on stocks because of news earnings, or they'll say to not trade during FOMC announcement. But these also give opportunities for higher IV. So it's all really depends on your strategy and if you have another form of edge. If the option pricing is saying that the expected move of a stock might be $20, but you think it will only move $10, then you might want to take the trade. The EM or expected move is usually derived from the total cost of an at the money straddle and adjusted for time, giving a plus or minus dollar value. So when you really get into iron condors, there are all different types of strategies and all different ways of managing them. So that's the end of this video. I guess I will be trying to make more in the future. If you guys want one-on-one help with options trading, then you can join my friend's Discord called the Trading Lounge. I'm an analyst on the server and I do post my trades on there. There is a $20 a month premium version that has more information, gives you more perky perks, and maybe even some Percocets if you're into that stuff. But if you're broke as a joke, then I would just recommend the free version. All right, adios amigos. See you all next time. If you enjoyed the video, please dislike and unsubscribe.